Hey there, educators. Investments can feel like a pop quiz you didn't study for. Like terms like stocks and bonds, mutual funds, annuities, they can sound confusing or even intimidating. So today, we are breaking it down with simple visuals that show exactly where each one fits, from safest to riskiest. You'll walk away knowing what belongs in your now, soon, and later buckets. No guessing required. Teachers, you give so much every day. You're shaping lives and you're inspiring the future. But when it comes to your retirement, the path forward can feel uncertain. If you're an educator juggling demands of busy schedules and financial stress, you are not alone. Many teachers worry about outliving their savings, or managing their pension, or ensuring long-term care without burdening their family. With pensions often alone falling short, many educators struggle to bridge the gap between what they need and what they have for a secure retirement. That's where Educators Financial Foresight Weekly comes in. Each week, I'll guide you through clear, actionable steps to understand your pension and spot hidden gaps, build retirement income strategy tailored to your needs, protect your savings from inflation and unexpected costs, and plan for long-term care and estate needs without burdening your loved ones. Your career has been about making a difference. Tune in every Thursday at 11:30 a.m. Eastern on YouTube and LinkedIn. Let's build a retirement as rewarding as your career. Welcome to this week's Educators Financial Foresight Weekly, your step-by-step guide to financial peace of mind. Like every week, I'm your host, Debbie Major, former educator turned financial planner, and I'm here to help you protect your future and reduce your stress. If you missed last week's episode on simplifying your finances in 3 easy steps, the replay is available on my page. And today we're going to dive in and turn to something that most people think that they understand or they don't understand. It's usually one or the other, right? Until you discover that it's more like answering an open-ended question on a final exam where the best answer depends on the context instead of simply filling in a bubble sheet test. So when it comes to investments, most people either want to put all their money into what they know or what's familiar to them. It may grow a lot over time. It may have a lot of risk. We don't know, but we know it, right? It's familiar to us. Or we chase, people say, I don't really know much about it, but I want the highest return possible, right? And not think about the risk. So here's a little classroom analogy, right? Imagine assigning group projects. Well, some groups, like savings accounts or bank CDs, you could consider them your dependable students. They'll work hand in the work on time, but it's not going to be groundbreaking work that they give you. Others, like stocks and currency, are your creative wild cards. Now, amazing results could be possible, but they may miss deadlines, they may lose their notes, and they may surprise you in unpredictable ways. Without understanding where each one fits, your portfolio can be imbalanced, either too safe and slow growing or too risky and stressful. All right, so let's talk about different investment choices. I'm going to start with the things you can choose from that would be your safest with your also lower rate of return, and I'm going to end with what you could get, what would be the riskiest, but you also have the potential for a higher rate of return. So if we start at the very lowest level or the safest investments we have, we're going to start at the bank. And we're going to start with our savings account and our checking account and maybe our high yield savings account. If you want to take it up a notch, you can get a CD. All those are backed by the government. They're FDIC insured, and so they are considered the safest investments that you have there. And you'll also get the trade-off of getting a low rate of return. Moving up from that, still considered very safe, but offered by insurance companies are going to be your fixed and your fixed indexed annuities. These are going to, they work very differently, and they are different types of annuities, whether fixed, where you know your rate of return, or fixed indexed annuities, where you may have a chance to participate in an index, which would let you know whether the market goes up or down. Either case, your money still is always at the insurance company, and the insurance company always takes on the risk. So you have a chance to not lose, you for sure will not lose your principal or your capital. You will just only gain whatever interest rate it is. All right, that's going to be your next safest option, and these are the only options that will protect your principal where you won't lose anything. If you're in the bank or CDs or in annuities, fixed index annuities. All right, starting to get into safer options that are also in the market or have some risk to them. We start off with bonds, and there's lots of different bonds out there. Their safest are considered the government bonds issued by the United States. There's also municipal bonds, and then there's also corporate bonds, and those would be issued by companies. And people issue bonds, companies or the governments, to raise money for themselves so they have money to use. When you buy them, you know what you're going to get for your interest rate. You know what you're going to get at the end when you get your money back. So you know everything along the way. And so that's why it's considered a safe option. The risk you have is whether something goes out of business or defaults on the bonds. Next, we come up with variable annuities. Now, variable annuities are annuities where you can be very much in the market because they have what's called sub-accounts, which are mutual funds for you to invest in. The risk is on you, and you take the risk of the investment on you, but you do get some protections from the insurance company. So if you're looking at a variable annuity, make sure you look at all of the fine print, make sure you look at all the fees, all of that kind of stuff. And make sure that you invest according to how you're comfortable investing and know what sub-accounts that you're in. That's really important. So make sure you do that. But it is, because there are some protections, it's a little bit it's not as risky as if you were just directly to go into mutual funds. There's lots of mutual funds out there. In fact, there's thousands of them. And they have, there's also, exchange traded funds and index funds and actively managed funds. There's lots and lots of choices. No matter which one you pick, mutual funds are going to be made up of stocks and bonds, and thousands of them. And that helps to spread the risk around a little bit, and that's why people like them, because you're not so heavily into one company or versus another, but you've got a variation of everything. So you take on a little bit more, you have more diversification. So in theory, you have more spread to your risk. You can see mutual funds that are all bonds. You can have mutual funds that are all stocks. Depending on what they are. So the important thing is know what the objective of the fund is, so that you know whether it's trying to get growth, where it's investing. They'll tell you where they're investing, and have a good idea of, does this fund look like it's going to match up with what I want to be in. After this, or a little bit higher on the scale, are going to be your individual stocks. Now, individual stocks, the reason why they're higher up on the risk scale is not necessarily because individual companies, by and large themselves, are going to be, riskier or not. I mean, we can say there's a whole plethora right there, but it's mainly because whatever you buy, you're owning part of that company, and if that company goes down, you lose everything. Or if it really makes a dip in the market and never comes back, you've lost that money. So you take on the risk of that company doing well or doing poorly, and that risk is all yours. It's not mitigated at all by having any other risk like a mutual fund would have. So that's why it's on the riskier scale. You can make a lot of money if you get in on the ground floor for a company that becomes huge, right? Or you could lose it if something were to implode. So that's the way you want to think about individual stocks. I'm owning part of the company, so you want to know how well the company does. And then I threw in cryptocurrency. On the risk scale, I still say that's way up there on risk because we don't know. It's been very, very volatile. Wild swings of way ups and way downs. If you ever watch the Bitcoin or some of the other cryptocurrencies that there are. And that's part of the reason why I have it there also is it's not just one. There's several different kinds of cryptocurrencies you could buy. It's still kind of an unknown. We're still figuring out how we're going to label it and regulate it if we are, and what we're going to do. So it could, whatever you put your money in, you could have the potential to make lots, and you could have the potential to lose everything you put in there. So you want to make sure you're always aware where you're putting things. And if we look at our bucket plan with our now and our soon and our later buckets, you know, the now and the soon are going to be pretty much where your safer investments are going to be, because those are things that either you're using this year or you're going to be using sooner rather than later. And because of that, you know, you want to keep to some of the safer options that you've got out there. And then for your retirement funds, especially if you're a long way off from retirement, usually we go a little bit riskier with those and say, you know, let's get into some mutual funds, let's get into some companies that have a chance to grow, because you can take the chance of it going up and down and coming back up if you've got 30 years in the future for it to grow. All right, well, first I would like to hear from you. So if you could drop in the comments or send me a DM, and which type of investment do you feel most confident about right now? Things that are safe, things that are moderate, things that are risky? I would love to know. And here's why this matters. And it goes along with your risk tolerance. Your risk tolerance is how much risk you're comfortable taking with your money without losing sleep at night. And it's going to be different based on who you are, and it can also change over time. So you may find that you are riskier when you're younger and more conservative based when you're older with your money. Pretty common, and most advisors will actually want you to move your money a little bit more conservatively as you get older. That's kind of a typical way to have it grow. But beyond that, you know, some people are fine with the ups and downs of the market. And others, you know, they want slow, steady growth. They don't want to lose money. And it's important because if your investments don't match your personal risk tolerance and your time horizon, you could either be missing out on growth, or you could be taking on more risk than you can handle comfortably. For example, if you're not comfortable with the ups and downs of the market and your mutual fund has lots of stocks in them and it goes down in value, takes a big dip, you're going to be tempted to sell at that loss when it's low, instead of waiting for the stocks to come back and for the mutual fund to be able to come back and balance that out. So it's really important that you match what you have, where you have it invested, with your risk and what you are ready to risk away, and put your risk in, how risky you are and feeling for your investments. Here's Rookie's quote of the week, and it's his own. He says, the safest place for your lunch is in your own lunchbox, unless you want to share it with the squirrels. So just a funny little quote for this week. Keep what your important money protected. Only take risks with what you can afford to share. That's kind of the moral of the story. Okay, so let's wrap up today's Educators Financial Foresight Weekly just with a couple thoughts. One, you know, investments don't have to be complicated. You can make them as easy or as complicated as you want to. But if you think in terms of your buckets and you think balance and think about when you need your money, it'll help you to make choices on where and how you want to invest. If you'd like to have the free investment options safest to riskiest chart, you can just comment chart or send me a quick DM. I'd love to hear from you. Thank you so much for joining me today. Please be sure to like and share on YouTube and LinkedIn, and I will see you next week. Have a good one.